On board Chakri Lokapriya as well. Chakri, hi, good morning. Good to be speaking with you. Let's start with OMCs itself, because when we were talking to a whole host of experts on the budget day as well, there were quite a few people who were positive on OMCs despite the massive run-up that we have seen in the last 3 to 6 months. What's your view on the sector, and if there's any preferred bet in the space?
OMCs as a space, despite the run-up, they still continue to be valuation-wise still very cheap. But what remains, kind of uncertain is in terms of price pass-throughs in case oil rises and there's, because of the Red Sea, etc. If there is a price increase, then who bears the price cut? The price change is the question. So therefore, I think on the other hand, if you look at companies like Oil India, ONGCs in the same oil pack, they are far better placed because, they have the benefit of both downstream and upstream. And I think ONGC and Oil India are looking good rather than the OMCs.
Okay, fair enough. Chakri, let's also get in your take, because there have been quite a few companies that have come out with their quarterly numbers, so lots of result reactions. What's the outlook then on something like an Apollo Tyres? The margins have expanded. You've also seen the net profit grow. And for instance, you've also got something like a Fortis, which came out with its quarterly numbers. It was a bit disappointing this quarter.
If you look at auto companies, auto ancillaries, or even earnings in general, earnings have grown overall anywhere between 17 to 19%, which is a very good number, excellent number. And the market itself is trading at probably about 17, 18 times on 26. So the market is not overheated. Now, JK Tyre is a perfect example of, really, really good numbers, but the expectations were high. And therefore, the stock saw some amount of correction. But still, after this correction, the valuation of the stock looks very attractive. And the outlook, because, the raw materials are in control, the demand is reviving, and the margins are expanding. It's like a textbook case of all these 3 or 4 factors which will help the stock to do well from the current levels.
Okay, so that's the take as far as the tire space is concerned, and the and the entire OEM as well as a basket. But shifting focus to consumption as well, Chakri, because we have been talking about how there has been this big dichotomy, rural versus urban India divide, and clearly it's showing in the stock prices as well, whether it's hotel, whether it's, other high-end kind of spaces, they are doing well. When do you see that there could be a pickup in the rural, plays as well, or is it a right time to buy in and wait for just that?
The rural is weak, and I think it'll probably take its own time. If you look at companies like Britannia, numbers were good, margins expanded. The biscuit demand was fairly strong, which is also consumed in rural. They had company initiatives which helped the margin, but the valuation is also up there at about 48 times. So the valuations come for the FMCG space reflect. And therefore, the rural spend is not so dramatically going to improve for the stocks to do well. On the other hand, if you look at an Indian hotels or a Lemon Tree or Chalet hotels, they reported really very, very strong numbers. Various aspects of their business, whether it is corporate spending or MICE or consumer spending, individual consumer spending, all of them are very strong. F&B is very strong. And therefore, the revenue growth rate is supporting its valuation. So still, I think we'll stick with the urban spend like the hotels.
Fair enough. Meantime, how are you looking into the entire euphoria within the PSU space? I know it's a very broad segment, but just owing to the kind of comments that have been coming in from the Prime Minister, the fact that this sector has been in the spotlight all of last year, where is it that you're finding extreme optimism, and maybe areas where you feel that there is perhaps too much exuberance?
I'm thankful that, we got it right more than a year ago. But again, to put things in context, if you rewind back, let's say 10 years, there were about 250 odd companies, PSU companies. Number is more or less constant. Market cap has kind of slightly more than doubled. So if you look at it from a longer term context, the market, the individual stocks in the PSU basket are not overheated. Now look at, in the last 1 year, of course, they have gone up multiple times. Many of them have been multi-baggers. Then look at a stock like, for instance, Chicago Wagon, gone up like 7, 8 times, 10 times maybe last 2, 3 years. The company is still trading at 28 times on its FY26 numbers. Now, 26 times for a company whose earnings is growing really fast is not an expensive multiple on the face of expanding margins. Now, we can expand the story to many of the other stocks in the PSU space. And therefore, I think there are still stocks to look at, but blindly buying PSU stocks at this level won't make one money because of the run-up.
Fifth consecutive strong quarter, not only a strong quarter, but a beat by Lupin. Do you think further re-rating from here on is possible in Lupin, or bulk of the good news is already in the price?
We've looked at basically the numbers, and, the business momentum seems to be pretty much intact. And it looks like, the beat can continue to happen for at least the next couple of quarters. Of course, in anticipation, the estimates will move up, but that is the good news, because as estimates move up, the valuation will be on its side. So I think Lupin as a franchise, I think looks good at the current levels.
Okay, so that's about Lupin and kind of, good numbers that the company has been delivering time and again. But Chakri, where do you see the case that one should take, probably look at trimming positions and book profit? Is it real estate? Do you think the peak is behind? Because earnings from a couple of those companies weren't the most impressive.
Yes, earnings were not that great, but in some of the companies, but in the case of their unsold inventory of the various real estate companies is coming down. Still, the overall inventory stands somewhere close to about, I think, 1.5 to 2 years. I'm talking about national averages. So individual companies, obviously, it's different. So against this backdrop, as interest rates peak and in the US start cutting, India will also do so. Most of the rates, home loan rates in India are on floating rate. So which means the cost of borrowing almost immediately comes down. That will provide a further fillip to real estate demand. So I think, yes, we should continue to hold on to real estate stocks and not trim positions yet.
But when the IPO came around $900, if I'm not wrong, everybody called it expensive. And the superior growth, the India growth part is well documented in the last 4 quarters, and the stock has doubled. And even now, I hear that this block, which is almost 850 crore thereabout, the book was seeing a lot of interest from funds. Would you buy at current level 2100, or would you sell if you already have participated in the last 1 year gains?
Mankind Pharma has done very well over the last 1 year, and it's continued to execute on its business franchise as well, because its consumer folio is very strong, its institutional business is developing, and the margins are improving because of the consumer business, which is holding on. Against this backdrop, its market share increases have been evident, and so I think while the stock has doubled, I'd clearly continue to hold on to Mankind Pharma, because the business operating measures momentum is still firing on all cylinders.
Have you had a view on this one, Catholic Syrian, or even DCB for that matter, where the Aga Khan Group wants to raise their stake now and have sought RBI permission? These two are not very often discussed banks.
Indeed, Ajay, I don't have a real firm view on either of the banks, but Catholic Syrian banks, one, the management has changed. Second, it has been a topic of speculation in the past of, whether it would change hands. Now, I think that speculation is kind of died down. But the business overall outlook in the part of the region where it operates is kind of recovering. The growth rates are still lower versus other parts of the country. So other than that, I don't have a firm handle on either of these two banks.
What's the view on Zomato?
Zomato will kind of show some kind of continued trend towards, trying to improve its profitability. I think the focus here is on a margin. Maybe it's not, a fair thing to ask of this company given its growth path, but the focus will be on margins if it can show some kind of improvement. On the face of overall kind of weak consumer, I think that will kind of still weigh on the stock.
Yes, so did you catch the commentary coming in and also the results? See, after yesterday's big move too, VMart is gaining 1% today.
Indeed, I think VMart as a space, is strategically well positioned in the tier 2, tier 3, tier 4 kind of towns where it is expanding market share. There you don't have organized retail like the way V-Mart does, and V-Mart does a good job. Their acquisitions, etc., kind of held them back a little bit. Now, if you look at recent spending growth by the consumer, the Indian consumer, you've seen credit on the smaller items, smaller ticket items, actually increasing rather than the big ticket items. I think that is good news for a V-Mart. And I think, so therefore, I clearly I'd look to start buying into the stock because I think it's on the mend. You won't look for pricing power, but you look for volume increase.
On that note, Chakri, we let you go, but let's quickly